Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. China stimulus boost. Chinese stocks and commodities rally after the central bank unleashes measures to shore up economic growth. Top officials weigh in as UniCredit boosts its interest in Commerzbank to 21%. German Chancellor Scholz calls the bid unfriendly, while Rome's vice president backs the Italian lender. And a major escalation between Israel and Hezbollah. Israeli airstrikes kill nearly 500 people across southern Lebanon in one of the deadliest days of fighting in 20 years.
In the meantime, a quick check on these markets here. You're seeing green on the screen when it comes to the equity picture. Specifically seems like a read-through coming out of Asia. We're going to dive into the details. Outperforms at the moment. Your stock's 50 futures higher by 0.7%. FTSE 100 futures right on its heel as well. But strength in the currency, $0, 111. Cable sticking around at a 133 handle. The countdown to the opening trade starts right now.
Tuesday the 24th, good morning. Have Chinese equities finally bottomed? Is this the bounce? Is this the bounce that is going to be sustained? That is the question that I think a lot of managers are going to be asking themselves this morning. We have seen a big move by the PBOC. We're getting an announcement, we think, on the fiscal side a little bit later on today. Anna, is this a move that is going to be sustained? Yeah. Is this a move that has legs, or is it another head fake?
Yes, is this the big one? We've seen piecemeal moves from Chinese authorities on lots of different fronts over the last few years. We've seen Chinese stocks at a 5-year low. We can show you how Chinese assets and beyond are responding in terms of stocks, the Chinese currency, what's going on with commodities. Iron ore prices up more than 4% in session. But let's get to the facts and what we know so far. Let's bring in Bloomberg's Rebecca Chung-Wilkins in Hong Kong. Rebecca, bring us up to speed with what we need to know.
Yeah, a real barrage of moves here, and I think both the scale and the timing of these various monetary policy supports that has been somewhat of a surprise, a pleasant surprise to investors. So we've seen a 50 bips cuts to the triple R, 20 bips to the 7-day repo, 50 bips to the average mortgage rates as well. The possibility of a stock stabilization fund to try and put a bottom on those poor Chinese equities, the performance that we've seen there that you mentioned, and also this move for the PBOC to take over full responsibility, 100% of the loans that are being issued by local governments to buy up and mop up some of this excess unfinished housing supply that has plagued the property market for years now. So a real sort of broad sweep of measures and quite a sort of surprising format. Now, this is pretty normal for some parts of the world, but in China, to see the PBOC governor sit on stage, do a live press conference in the hours where investors, international investors particularly too, can watch, sitting alongside his colleagues. We had the chief from the finance regulator, the chief from the securities regulator, essentially these three announcing all the policies that they possibly could in a coordinated, seemingly transparent effort. Also seems to be specifically targeting, trying to restore confidence among international investors, as well as speaking, of course, to that domestic audience.
Rebecca, thank you very much. Bloomberg's Rebecca Chung-Wilkins in Hong Kong with the latest on those Chinese measures. I mean, yes, is this going to be more than just a short-lived bounce? We've seen what it does to stocks, we've seen what it does to commodities, and we will certainly keep an eye on that as we come into the European session, because this is something that could boost some of those basic resource stocks. Absolutely.
Potentially some of the luxury names as well could be impacted by this. Ministry of Finance is going to brief a little bit later on. The key question to me is, does this translate into something that is sustainable? Getting the stock market moving is one thing, getting consumers spending maybe is something different.
Well, the fact that Rebecca was talking about that stock stabilization fund, $113 billion worth of liquidity that basically backstop some of this investing. We know that China, of course, has one of the biggest retail markets in the world and that consumer participation. The other piece of this as well is the Bloomberg Economics on that topic of sustainability, talking about a 0.2% increase to growth for 2024, but saying by 2025, all of that goes away.
Yeah, interesting to see what European investors do with this, whether, you know, Europe has a lot at stake here. There's a lot of connection between the European economy. You mentioned luxury. We can talk about commodities, all kinds of exports, between what goes on in Europe and China. And so we'll see how European investors respond. Given the geopolitical tensions, that's overhanging the market as well. Despite that, stocks in Europe are called higher.
European stocks have got a lot to think about at the moment. The banking sector firmly in focus. We'll see what happens today with Commerzbank. Yesterday was a wild ride for the stock. We had news that Orchel had boosted his stake, or could boost his stake, with derivatives up to 21% from 9%. The Germans didn't like that. The Italians are starting to get a little bit testy as well. They're wondering why cross-border takeovers are not possible at this point. The ECB is probably going to be thinking the same thing as well. But what does Commerzbank do? What are the other options here if it is not UniCredit's? Is this a standalone option? They don't have the management team at the moment to be able to do that. Other white knights potentially stepping in. Very difficult to do when you've got Orchel sitting there with 21%.
Yes, indeed, or options to take it. Has an economic stake of 21%. So I enjoyed reading the piece our team put together about Italy's response here. Because on the one hand, they're saying to Germany, well, hang on, you can't say that you need lots of European cross-border consolidation and not accept it in your own backyard. But some in Italy actually kind of cross with Orchel about the way he's gone about doing this and what that might do to relationships between Rome and Berlin. So there's clearly more at stake than just the banking sector, and just the banking sector is a lot.
Hard to crack the habits of a deal maker, it seems. New at 21%. He's still talking about regulatory permission up to 30%, despite saying this is a friendly business deal. This feels like a win, though, for Italy that has not necessarily had the greatest winning streak when it comes to the banking sector. Orchel really turning that around.
Does UniCredit become a German bank, though, if it takes over Commerzbank? Does it take on some of the benefits of being German, i.e. lower borrowing costs, that you could think about going forward from here? If he doesn't get to take over the whole business, does he merge with the HVB unit with Commerzbank? There's lots of different permutations here that are still at play.
How on earth is he going to take the German government along with him? I mean, Scholz saying this is an unfriendly attack doesn't sound like the foundations for something sustainable and long-lasting, but we'll have to see how this plays out.
It's certainly something we're going to keep our eye on. Another major story we have our eye on from around the world is, of course, the tragic attacks over in Lebanon. 500 people killed. This is yet another escalation of the war in the Middle East, the deadliest day in Lebanon since going back to 2006. This is crucial in terms of where the United States actually plays a role or doesn't play a role. We've been talking about the escalation in the region for a while, and this time around, it feels like this is just getting worse and worse with no diplomatic solution on the horizon.
Yeah, the US saying that they want to break this escalating cycle. Hezbollah's weapons, of course, getting further and further into Israel as they are armed with new weaponry as well. All of this taking place in the context of the UN General Assembly, which is happening right now in New York, is about to get underway. And Gaza was already set to be one of the big topics of conversation, and now the northern border of Israel will be as well.
What does Netanyahu say? What do the Iranians say as well at that UNGA meeting? I think it's going to be really interesting to hear exactly kind of what the Iranian line on all of this is. It is deeply involved in all of these stories. Is this going to translate, though? Are these air attacks going to translate into a ground offensive? I think is the question that we still don't know the answer to. Is this just an effort to push Hezbollah back further out of range to make the northern part of Israel habitable again? I think that's the key question that we still don't know the answer. If we take the next step, then we are into a whole different ball game. Let's talk about what else we've got on the agenda today. It's a packed schedule today.
Plenty going on, and a lot of that has to do with right here in the UK. At about 2 p.m., we get that speech coming out from Keir Starmer. Plus, of course, our eye on the UN General Assembly. Nigeria's rate decision is going to be in there as well. And then plenty of data. That U.S. consumer confidence number at 3 p.m. could be a tradable one, especially as we talk about yet another jump in the stock market. Plus, of course, the OPEC annual world oil outlook at 6 p.m. And the Bloomberg Business Forum will begin at 8:30 p.m. We've got a lot going on, a lot of major speakers, a lot of central banking speakers, and I believe, of course, President Biden as well, speaking at the Global Business Forum over in New York.
Yeah, looking forward to hearing what he has to say. Certainly a key event for us here at Bloomberg. Michelle Bowman's going to be speaking a little bit later on. Other Fed speakers do sound like they are talking about maybe significant rate cuts from here. She resisted. Is she going to continue to resist, and what kind of language is she going to use? Yeah,
it's interesting. Our reporting suggesting that the Fed speakers we've heard from overnight, leaving the door open to 50 again, not by any stretch saying that's going to happen or that's their favoured approach, but there does seem to be that door open. Another thing that stands out then in the daybook is we're going to hear from Keir Starmer at the Labour Party conference. Yesterday, I mean, we got quite a lot of politics, didn't we? Not sure we got all that many answers in terms of where the economics goes. And we got a lot of looking back, COVID contracts and the like getting a lot of mentions, and a mood reset is what they're attempting to do, apparently. And that's what we might hear later on from Keir Starmer. Light at the end of the tunnel is the messaging that we can expect.
Does this show up in the markets? What happened to that kind of island of stability narrative? It feels like it's starting to shift, and yet in the markets, you're still seeing strength in the pound.
It's stable. It's just a bit gloomier than expected, maybe.
Yes, it feels very dreich if you were to put it in Scottish terminology.
British optimism.
Bit gloomy and a bit kind of downbeat. That seems to be where we are at the moment. Though Goldman Sachs raising its target on sterling, it now sees that going to 140, which is something we haven't seen for a long time. I'm old enough to remember when we were at kind of 2, but we feel like we're a long way away from that. But 140 feels like a win at the moment.
Yeah, wake me up when we start talking parity again.
That's,
or 2 to 1,
or
sorry.
2 to 1.
2 to 1 is what I meant.
That's a shopping trip to New York. What else do you need to know this morning? Let's update you. Donald Trump says that if he returns to the White House, his first call will be to the Chinese President Xi Jinping. He has accused Beijing of failing to honour an agreement that saw the US reduce some duties in exchange for China increasing its purchases of US exports, including $50 billion in agricultural goods. The US presidential race has seen both Trump and Harris vow to take a tough stance when it comes to Beijing. Bloomberg has learned that the US Justice Department plans to allege that Visa illegally monopolised the US debt card market. Sources say the Department of Justice Antitrust Division is set to file a lawsuit as soon as today, accusing the operator of the largest US payments network of anti-competitive conduct. This will be the culmination of years-long probes of Visa's business practices. And Boeing has increased its pay offer to Seattle factory workers to 30% following a strike that has shut down its aircraft manufacturing across the Pacific Northwest. The US plane maker says it will also reinstate an annual bonus and increase pension contributions, but the union says the vote can't be held at such short notice. What else we got?
Yeah, we'll continue to monitor that then and see if that brings people back and watch the aviation sector. Coming up, we will be at the Labour Party conference. We've mentioned that Prime Minister Keir Starmer is going to be giving his address from that conference later on today. Plus, Danny Berger is at the Kepler hedge fund conference today, talking liquidity with some guests who are in attendance at that event. So certainly stay with us for those conversations. Up next, though, we'll talk about China's stimulus package, and it has already, of course, boosted Asian markets. We look ahead to the European Open as well. If you have any questions you'd like us to put to our guests, please do get in touch. IB plus BBTV Go. That's the function to use on your Bloomberg. This is Bloomberg.
This is basically to ensure this year China can deliver the around 5% growth target. With the stronger support now, I think we're going to see basically some kind of a lifting effect.
If we had more fiscal policy stimulus, that would certainly be more important in really driving activity here, given the low level of confidence amongst a lot of households and also businesses in China.
Bond issuance quota still quite a bit of left still being unused. So I think that is sort of holding the physical stimulus back.
What happened today, I think it actually raised the expectations of more coming, especially for today. It's more on the monetary side, and I think market would expect there will be more announcement on the fiscal side.
And that announcement could come a little bit later. Reaction from our guests. This after we saw China's central bank unleash a new round of stimulus. Maria Demetsis, European chief economist at the Conference Board in Brussels, joining us now to discuss all of this. Maria, we look at this from a European perspective this morning. Is this good news for Europe? China finally seems to be delivering the stimulus we have long anticipated. There is an expectation that maybe the economy can turn a corner as a result of this. What does this mean for the European economy?
Certainly it's good news. The European Union and Europe more general is an export giant. It relies very much on markets outside its own territory, and China, of course, is a very important market for Europe. And therefore, any good news that we can hear about Europe, particularly now that the European economy is at a difficult spot, will, of course, be welcoming news. But need to see how long it will take for the stimulus in China to actually feed through into domestic demand. And from that, of course, the European exports.
How quickly do you think that could happen? Try and give us a sense of how quickly you think this could take place. How quickly does this spill over into the regional economy, into the global economy?
I just don't see it this year. I think it will have to be next year. It's very, very late now in the year for something like this, for the preparation of firms to be able to absorb this demand. So my best guess would be next year.
OK, so that's our expectations around China. In other news over the last week or so, Maria, we've seen a lot of talk about consolidation within the banking sector. Commerzbank, of course, the subject of that kind of activity and that kind of approach from UniCredit. We'll see how that plays out. But taking the sort of broader significance of that story and those developments, consolidation within the banking sector has been talked about by many as one of the missing ingredients in Europe. How significant can that be for the European growth story?
Well, I think the consolidation story of the UniCredit Commerzbank has been a little bit overplayed. UniCredit has got a very big business in Germany, and therefore the consolidation of buying up Commerzbank, at least a share of Commerzbank, is really not very big news. Consolidation, on the other hand, and particularly if we allow for cross-border banking, is very good news. This is exactly what we need in the European Union. We need cross-border businesses in order to generate a much more active single market. One consolidation of two banks in Europe will not do the trick, but it is certainly something that should be allowed, provided, of course, it fulfills all the rules and regulations of DigiComp, the competition rules that are important. I don't see any problem there. In any case, this is something that should be allowed to happen because it will make businesses more productive and it will allow for a single market for banking services to develop.
Yes, and Maria, this was something that Mario Draghi picked up on in his report about competitiveness and about staying, going toe-to-toe with China and with the United States. What else stood out to you, Maria, from that report as being really crucial for Europe to deliver on?
Well, I think there is no simple answer to this question, and Mario Draghi used 400 pages to diagnose the problem and provide some solutions. But I would argue there are really three things, three umbrella themes in the Draghi report. The first one, of course, is investments. He identified 800 billion investment gaps from now to 2030. Europe needs to accelerate the speed in which it invests on technology that are of crucial importance to its business and to its economic security. I am not very hopeful that this will happen very quickly, but it's absolutely essential that it does. The second thing that Draghi identifies, in my view, that is of crucial importance is complexity in regulation. We pride ourselves in the European Union for creating a lot of regulation with very good intentions indeed, but it has actually prevented business from growing. It really plays down the productivity issue, which is absolutely essential for Europe. So Draghi is asking for simplification, and I'm hoping that the European Commission is going to lead the way once the new college is approved by the European Parliament. And the third thing is indeed economic security. This is actually perhaps the most interesting part of the report, in my view. It applies to both industrial policy, so subsidizing those industries that are going to be beneficial for our own economic security. And of course, it means trade. The approach that Draghi takes into trade is really quite novel, in my view. He's asking for a differentiated approach to trade agreements. This is actually very new, in my view, and the fact that Draghi gives it seals of approval is of great significance. I think we are going to see a turn in the European Commission's approach to the way that it approaches trade. And that is going to be very different to what we've done in the past. There will be a lot more protectionist tendencies in this respect. And they are strategic in terms of who they target. But they have one objective, and that is business continuity, therefore economic security.
Maria, so much of the gap in investment and gap in funding that you're referring to and that Mario Draghi was referring to is really a function of the growing deficits across Europe. And I'm curious how, in your view, how dire the risk is of lower fiscal adjustment. Now that we're talking about delays coming out of France, out of Spain, out of other economies as well, how big is the risk and how much worse does it have to get?
A very good question. After two crises, fiscal positions in Europe are indeed strained. But I remind you that the new fiscal rules have come into operation this September, as we speak. And the countries that have to submit the budgets to the European Commission for approval need to count on the fact that the European Commission will be watching very, very closely how compliant the country budgets are with the new fiscal rules. There is room for flexibility. There is room for discretion. But there will be, in my view, no attempt by countries to compromise the debt positions, which now has become the most important thing. So I think the fiscal positions are not as dire as you said. I think there is space to grow. And in any case, the way that the European Commission will be monitoring the fiscal rules, I really don't see any risks arising from that.
But Maria, what is the doomsday scenario in that case? If you're talking about some of these rules getting broken, name your country who may do that or even delayed, what's the worst thing that can happen? How can the European Commission hold countries accountable to the budgets they put forward?
That's right. I mean, I think you're pointing out to the governance issue. The European Commission has got tools to discipline a country, and that is to impose fines. The reality, however, is that the European Commission has never imposed fines on countries. Now, that said, we have had the financial crisis and we have had programs, and programs were extremely invasive. So I do not exclude the possibility that if a country were to come into a very dangerous position on the fiscal side, that the European Union, the European Commission together with the ministers of finance of other countries, that is the European Council, in other words, will in fact impose discipline and try and impose program-like types of actions. Now, this is a doom scenario. It's not something that is I foresee will happen, but having done it during the financial crisis, we now have established the precedent. And even if it's not in the competence of the European Commission, there is the ability to impose tough sanctions on countries.
Maria, I looked at the PMI data yesterday and it made grim reading. What do you think the ECB will make of that data, and should it be accelerating rate cuts?
Well, I think it will be paying very close attention. Germany, we are forecasting here at the conference board the growth to be at 0% without having accounted for the new data. Indeed, I think this will be news for the ECB to try and accelerate the speed at which it's coming down. It's not very good news, but I'm afraid it's not just temporary news. The growth model that Germany is following needs to be rethought, and therefore is not something that is going to go away anytime now. Nevertheless, any help that can come from the European Central Bank, and it will come, in my view, will be helpful in terms of lowering borrowing costs. But indeed, I think this is something that will stay with us for the foreseeable future.
OK, so lower borrowing costs would help Germany, Maria, and we've seen a lot of talk about what happens with the car sector in Germany. Are you expecting the government there to try to take measures to protect the car sector, given what you were saying earlier about business continuity and security and the way we've seen tariffs being discussed?
Yeah, indeed. Well, I think, tariffs is one thing, of course. The European Commission and the European Union had always followed proportional approaches when it comes to tariffs. So if a country, a foreign country, imposes tariffs on the EU, then the EU effectively retaliates proportionally. I do not see the European Union imposing tariffs in an active way. However, what it can do is provide subsidies. This is something, of course, that needs to be done in the context of the laws that we have. We have very specific laws that forbid the giving of subsidies because of the threat that it imposes to the integrity of the single market. However, given the Draghi report and given the need to do something, I think that the Europeans will actually provide subsidies. And of course, the subsidies will be absorbed by the big countries for the big industries. That, of course, may include the car industry or any big industry that contributes to European growth. That, however, will require what I would call a big bargain. Something needs to go to the smaller countries for the smaller countries to agree to violate that.
Yes, Maria, thank you very much. Maria de Mertzis, Europe chief economist at the conference board. Thank you very much for your time. We'll pivot to the UK story shortly. Coming up on the programme is Keir Starmer's address to the Labour Party conference later today. Ahead of the Prime Minister's speech, we're joined by the CBI chief executive, Ray Newton-Smith. She'll be on the ground in Liverpool with Lizzie Burden. That conversation next. This is Bloomberg.
Yes, we must deal with the Tory legacy, and that means tough decisions. But I won't let that dim our ambition for Britain. So it will be a budget with real ambition, a budget to fix the foundations, a budget to deliver the change that we promised, a budget to rebuild Britain. And my budget will keep our manifesto commitments. Every choice we make will be within a framework of economic and fiscal stability.
UK Chancellor Rachel Reeves speaking at the Labour Party conference. Let's go there now, where Bloomberg's UK correspondent Lizzie Burden is standing by in Liverpool. Lizzie, walk us through how the Chancellor's speech was received on the ground.
Well, it was a warm reception publicly, Kriti, from the business lobby groups, but in private, executives tell me that they're really nervous about the tax hikes that may come in the October 30th budget. It was a policy-light speech, not a lot of detail, and we can speak now to the head of one of those business lobby groups in the UK, and it's Rain Newton-Smith. She's Chief Executive of the CBI. Good to have you back, Rain.
Good to be here.
I know that for business lobby groups, it's really hard to be publicly critical of the government. When you've got to sit round the table, you want to keep that seat with the government. But I hope you can be frank about your members' concerns. For all this optimistic pitch to investors, how worried are they about tax hikes in the budget?
Well, our job is to look at the policies we see announced and be honest about how businesses are feeling. And I think one of the things that was really important that the Chancellor set out yesterday, something we've really been encouraging them, is to lean into hope and confidence and really regain some of that mood and momentum I think we felt in the first couple of weeks of this government. If you remember back in July, even if the weather has turned now, there was that sense of optimism, and they were making decisions on reforming planning, on announcing more plans for house building, on removing the ban on onshore wind. And we know those are some of the things that have been holding back growth in this economy. So I think we need to see more of that. It's sensible in a way that we didn't see a lot of policy announcements yesterday, because one of the things that businesses want to see is stability and certainty. And that means in making sure that spending announcements happen at a budget is exactly what we want to see.
Well, I mean, when you have all of this counter-briefing over Sue Gray, the stories about freebies, does that sort of instability put business off investing in the UK?
I think some of the speculation ahead of conference, much of that businesses can ignore. What they do get concerned about, and what they did find, is the more that there was talk around the difficulty of the fiscal position, which businesses understand. The more time that was sort of spent articulating the fiscal black hole, it became really difficult to make that pitch to global Britain and to global boardrooms. Now is the moment to invest in the UK. And I think what we've seen at conference is a shift in the mood and a real focus on that long-term vision, and a real understanding that we need to be ambitious for the country, and we need to set out some of those policies. We need a long-term industrial strategy.
Yeah, OK, so that's the sort of tone that you'd like to see from the Prime Minister, Keir Starmer, I suppose, when he speaks later today. I caught a Labour minister on the way out of the Chancellor's speech yesterday, and I asked her whether the big plan is to spend the first term fixing the foundations of the economy and then get ambitious in the second term. And she said to me, it's a decade of national renewal, work it out for yourself. Can business really afford to wait 5 years for prudence to turn into prosperity?
I think the hard work has to be every day, and I think what we want to see is that building of momentum. And I think even yesterday it was good to hear the Chancellor set out some of the things and just repeat some of the messages that business need to hear, that we know we need a business tax roadmap that will be really mindful that corporation tax needs to be competitive globally. I think just repeating some of those messages is really important. And I think what businesses will want to see is more of a focus on a net zero investment plan to encourage investment, not just in clean power, but across the economy to encourage investment. And there's a relationship between public investment and private investment. Yeah. So I think having more fiscal space to unlock public sector investment will crowd in the private sector we need.
Well, so on that, maybe you know more about this than we do. Rachel Reeves said yesterday it's time that the Treasury moved on from just counting the costs of investment to recognising the benefits too. Do you think that they're going to move the National Wealth Fund and GB Energy off the government books to try to crowd in more of that private investment?
I think we don't have that level of detail yet, but I certainly picked up on the signals that I think the Chancellor is looking to create a bit more fiscal space to invest in public sector infrastructure, in some of the things we know we need. And actually taking the approach that many businesses do, that when you're making an investment, you think about the costs what you need to do to borrow to make that investment, but you absolutely think about the returns from that investment. And I think taking that approach as a nation is really important, because I think the Chancellor has been successful in establishing that credibility and fiscal responsibility, and that means we should be able to look at how we ensure that we have the public sector investment, because we know generally the UK is in the bottom league of the OECD countries in the amount that we invest publicly, and that's really important to get the private sector investment we know will generate growth.
And like I say, you're often around the table for these discussions, you're often in the room. Do you detect a rift between the Deputy Prime Minister Angela Rayner and the Business Secretary Jonathan Reynolds over the Workers' Rights Bill?
In the meetings I've been at, they've both been there and they've both been articulating some of the aims that they want to see from the policy. So that isn't apparent from some of the conversations I've been in. And I think the business leaders I speak to recognise we have shared aims around the Make Work Pay, but they're also very clear that we need to work through the detail to make sure that there aren't any unintended consequences, that businesses can still take risks on people and create the jobs that we need to see to really drive growth in the UK.
So there's this battle between the demands of business and the demands of the unions, but can the government really afford to be experimenting with working from home when you've already got productivity so low?
We don't see it as a battle. It's really about bringing all parties into the room and understanding the objectives, what are the shared aims, and then working through some of the details so that we can get to a solution that really works for the economy. It doesn't feel, we need to be in the room to see how we work through some of that detail.
OK. Ray Newton-Smith, CEO of the CBI, one of Britain's biggest lobby groups. Great to have you with me on Bloomberg. Back to you on the opening trade.
Lizzie, thank you very much indeed. Fascinating interview. Bloomberg's UK correspondent Lizzie Burden joining us from Liverpool at the Labour Party conference. One line really stood out. Lizzie talks about the fact that she spoke to a minister on the way out of the Reeve speech. Work it out for yourself. The consumer is struggling to work it out for themselves right now. We're seeing GfK consumer confidence dropping on the back of policy uncertainty. Business is struggling to work it out as well. We're seeing a lack of investment as a result of the ambiguity around policy. Yeah. We're 3 months into this government and we still don't have any certainty. Stability is one thing, but business needs certainty.
Yeah, business does need certainty, and that is difficult in the UK context when we hand over power really quickly. And of course, they had a long lead up to this where they were way ahead in the polls, so there would have been an understanding that there was an assumption they would win and they should have been prepared. But at the same time, we hand over power in a day, and so sometimes that takes time to hit the ground running. I was really interested also in what Ray Newton-Smith was saying, reading the mood music in the same way our reporters did on the fiscal headroom. Is there going to be more space to borrow to invest under this government? Are we going to see a tweak to some of those rules?
Some of the rules, and then also the flip side of that she also mentioned was that the corporate tax rate, and I don't think this is new, needs to be competitive globally. This is a conversation we're having in France. This is a conversation we're having in the States as well. And it feels like this is a race. I wanted to say race to the bottom, but it feels like a race almost to the top about who can maybe get the highest tax rate and the highest kind of piece of the pie from these corporates.
There seems to be an assumption that corporates have the broadest shoulders. There seems to be this idea, certainly in France and the UK at the moment, that this is an area that you can turn to for taxation. UK banks, the energy sector, do seem to be front and centre in this. And you are also seeing those at the top end of the income spectrum being taxed heavily as well. Be interesting to see how that works out.
Which comes in direct conflict with the idea of incentivising investment that you're seeing on the ground.
We will wait. We will continue to wait. We'll get some news in the budget. We hope we're going to get some news in the budget. Coming up, UBS sounding the warning on Swatch on concerns over the luxury sector. More stocks to watch next. This is Bloomberg. "17 minutes from the opening trade. What kind of an impact will the Chinese stimulus have on the European equity open? At the moment, it looks like a positive picture. We'll get to that shortly. Before we do, though, the Kepler Absolute Hedge Liquid Alternatives Summit is taking place across town today on the other side of London at Wembley Stadium, bringing together leading fund managers and investors from around the world. And our own Danny Berger is on this side of the Atlantic. She is there for us. Danny, over to you.
Thanks, Guy. With this glorious background behind me, unfortunately, No sports will be played today. We are talking hedge funds. I'm pleased to say I am here with Matthew Barrett. He is the head of manager research at Kepler. Matt, thanks so much for joining this morning.
Pleasure.
So we're just coming through this period of higher rates, challenging a lot of managers, trying to navigate that new environment. And now we're in a new one of the rate cutting cycle globally in full force. From your clients, where is the demand? What kind of products do they want now?
When we take a step back, really a lot of the universe growth through sort of 2010 through 2020 was for fixed income replacement strategies, because that was the problem within portfolios that allocators were seeking to solve for. Negative fixed income yields in Europe, low cash rates. So you saw a lot of demand for low volatility alternative strategies. Today, we've seen that really switch on a dime. So the real thing that people are concerned about is diversification, particularly against more traditional equity benchmarks and things of that nature. So these days, it's all about high volatility strategies and diversification. Think macro, managed futures, and the like.
Diversification, though, feels more complicated than it did. Coming out of a period where bonds didn't necessarily offset equities, when safe equities like utilities, all of a sudden we're talking about them being AI plays. Things like gold are now at record highs, so that's coming back. Have asset allocators changed how they view their strategies?
So they're starting to, but they're still, in my sense, sort of quite stuck in terms of running quite traditional asset allocation frameworks, 40% equities, 40% bonds. They have this 20% alternatives bucket, and they're looking for that alternatives bucket for their diversification. But they're still wrestling a little bit with how do we kind of deal with this new world that you referenced. But we really see hedge funds playing quite an important part in that.
Okay, but what kind of hedge funds?
Managed futures in particular. When you look at it statistically, it's one of actually the only true places you can find uncorrelated return streams is in the hedge fund space. And that's really where we're seeing.
Sure, but within that, there's been this rise of the pod shops, the multi-strategy manager, and they've become really popular, hoovering up both cash and talent. How staying do you think that trend is?
It really depends on the investor's ability to bear fees. That's one thing we obviously observe, is that the fee loads of those structures are very high. And I think as long as returns continue to be okay on a net of fees basis, investors will probably stick with it because returns have been good. But ultimately, it leaves them really with very little wiggle room in terms of should returns from those multi-strat opportunities start to reduce, then people will focus a lot more on the high burden of fees. But it definitely has caused a lot of friction in terms of new managers going to pod shops rather than launching on a standalone
Yeah,
basis.
just how intense is that war for talent right now?
It's been ridiculous. We really see it in just in anecdotal conversations. Really good quality PMs who would be running their own, multi-billion-dollar hedge fund shop get lottery ticket-sized sign-on bonuses just for turning up. We're facing an environment, obviously, where regulation is increasing. You have to deal with investors. Running a hedge fund as a business is not necessarily an easy venture these days. So when you're offered this alternative of a nice juicy check up front, we've seen a lot of people take it.
But that being said, the model of these, you don't have the one big star manager. You have all these individual people managing money. So is that era of you have this big star manager who gets all the cash flow, and is that over?
I think there's still a place for it, but generally one of the main trends we've seen is sort of the institutionalization of hedge funds, which is a lot less about that kind of star manager. Obviously, there's been some quite public examples where that necessarily hasn't worked out well for the allocators. So we've seen a lot more focus on kind of investment process, risk management. Should a star manager still fit within that box, then great. But equally, sort of the days of the maverick seem like they're resigned to history.
Well, okay, scandals in the past, we don't have to name and shame them, but scandals of hedge fund managers in the past, is it now looked at as a key man risk almost? If I'm an asset allocator and there's a star manager, I'm worried there's a risk something might happen to that degree.
100%, because we have seen many examples where the man becomes bigger than the firm, and are they really looking after their investor interests first and foremost? Ultimately, it's their capital, or seeking to further their own interests. This era of social media, you can create a lot of ripples through a public persona. That can be good, it can be bad, but we're definitely seeing investors focusing with a lot more caution on things like that.
Now, I'd be remiss if I didn't ask, because we are here in London, there's a lot of chatter, and it's just chatter at the moment, of this idea that there'll be more taxes levied on especially the asset management world, things like carried interest taxes, inheritance tax. Every now and then you get these examples of saying, I'm going to leave the country. This isn't for me. I wonder, among your clients and the funds you look at, how real that conversation is.
So it is real, and we have seen a number of, probably the first movers have started to move offshore. Not necessarily as a direct result of the upcoming budget, but certainly in response to kind of the higher tax burden. So we've seen a lot of people, particularly in the Middle East, coming out of London and moving over to Dubai, Abu Dhabi. Their finance scene is growing at quite a pace, and you can earn tax-free income.
Do you think something could actually challenge London as that financial services centre, though?
I think in this day and age of obviously capital and talent is globally mobile, no city or jurisdiction has sort of God-given right. London is obviously a great place to do business by virtue of history. I continue to believe that it is. We're obviously sitting here in London. My firm is based in London. But equally, you have to be cognizant that we're trying to compete globally and have to have a playing field that supports that.
Right, I love this. You're like, I'm in London, it's great, it's wonderful here, but you could be elsewhere. Exactly. Matthew, just before we go, I want to wrap it up with this. In terms of liquid alts buckets, there are more managers trying to package up private assets in a retail-like form. And things like ETFs, in the US, Apollo is trying to do that. Is this the right wrapper for these types of products?
We could spend 2, 3, 4, 5 hours discussing this. We saw this really actually in the UCITS space, which is actually quite similar in terms of the democratization of hedge fund strategies into essentially mutual fund format. We would view the current democratization as somewhat similar. It's certainly not been a smooth path. Overall, it's been a significant net positive for investors, but there certainly have been some points of friction along the way. So we're very excited about this opportunity. It makes a lot of sense that a broader swathe of client can get exposure to these return streams, but equally, as always, the devil's in the detail, and you need to do your manager selection, due diligence, and that becomes particularly acute when you're dealing in private markets, which are obviously less liquid.
Matthew, thank you so much. Really wonderful to speak with you this morning. And Anna, that was Matthew Barrett, the head of manager research at Kepler Partners.
Danny, thanks very much. A conversation there about diversification using alternatives. I can't believe a bigger crowd didn't show up for that particular conversation. I'm sure it's packed with investors behind the scenes. We will have more from Danny shortly. Let's turn our attention to what's happening here and now in markets globally, and a lot of the news flow coming overnight from China. Joining us now, our Markets Live executive editor, Mark Cudmore, with Market Reaction. Mark, just looking at where we are on the Asia session, still we see a lot of positive risk-on reaction to what we've heard from China. How long-lasting is it, do you think?
Very long-lasting. This is momentous. We'll remember this day. We've been talking for the last couple of years when China would really deliver stimulus in style. And today they delivered something for everyone. It was a cocktail of stimulus. Most importantly, they really aggressively targeted the stock market. There's PBOC lending for funders and brokers to buy stocks. They're facilitating stock buybacks from listed companies. They're talking about a stabilization fund. But the point is, it's not just that in isolation. They've got something for the property sector. They've got something to ease mortgage rates. They've got something to ease consumer lending. They're helping M&A and to reignite animal spirits in the business sector. There is monetary easing across several different rates. This is really an incredibly comprehensive package. And it was surprising that it took markets a while to adjust just how big it is. And I guess that's because we've had several years of promises and not following through. And of course, even on this one as well, there will be some details that will be important to iron out the impact. But that's missing the point. This is the first time they've delivered across so many sectors at once, and they've already given some powerful details and some power measures. This is a really big turning point for the China market story.
China markets. What about the Chinese consumer?
That is the ultimate big question of how sustainable this is. Does this change the China narrative? I think it's really important. I'm giving this really, really bullish spiel here. This does not bring us back to the China story of the mid-2000s. China's not growing at 8% again. It'll be wonderful if it can achieve consistently, above 4% in the years above. It's probably going to miss the 5% target this year. Still, above 4% growth is more than any other developed economy in the world, or at least most developed markets in the world. This is still very, very good growth. Will the consumer property start spending again aggressively? It'll be a tough one, but they will start spending enough in the interim, and importantly, they're going to start putting money back into the stock market because the government has made clear they will support the stock market. And very importantly, they must make this work, so they will. It is still a state-directed economy, and they have said today they are going to make the stock market going higher, and consumers will listen to that message.
So the stock market, Mark, really quickly, let's talk about the housing market as well. We're talking about mortgage rates getting cut pretty substantially, down to 15% to 25% on that payment ratio. How much of a difference does that make?
It's not going to suddenly be a bull market in the property sector. but it's helping this whole bottoming process, which is a long-term process. It's a stabilization here. I no longer think the property sector is going to be a sufficient drag. It's already lost its importance, its weighting in the markets there. So if we stabilize that sector and we get a boost in investment in other sectors through the M&A mood, if we improve the mood of the consumer, and if we just create animal spirits again, then there is a bullish story here, even though property sector is not suddenly a bull market itself.
All right, Bloomberg Markets Live Executive Editor Mark Cudmore, we thank you so much. Let's go from the macro straight to the micro. Joe Easton with our stocks to watch. Joe.
Morning, Kriti. So UBS is this morning joining the growing list of banks getting more bearish on the luxury sector. One stock they're recommending selling is Swatch over in Switzerland. They've got a price target in that which is one of the lowest on the street as well. They also downgrade their rating on Moncler and even cut price targets across firms like LVMH, Hermes and Richemont. But bear in mind, given the Chinese boost that Mark was discussing a moment ago, that might take the edge of some of these downgrades. Also, we're looking at Raspberry Pi. Now, viewers will remember this one as the company that IPO'd in London just a few months ago, back in June. Really strong numbers out of the computer company. Earnings up around 60%. But as we can see from the chart, the stock not really done too well since it listed. But they did choose London over New York. That was seen as a positive for the city. So we've got an eye on that one today. Then staying in the UK, a couple of decent share sales this morning. Firstly, we got one out of the big insurer Admiral. This is a group of employees and employee trust offloading stock at a discount. Then Dangote, the retailer that got a boost yesterday from an upgrade, that one is seeing its chairman selling down stock at quite a steep discount, could be lower today.
Joe, thank you very much. Our equities reporter Joe Easton will look for a response to Chinese policy moves in the European session. This is Bloomberg.
Tuesday the 24th, couple of minutes ago until we start trading. Let's think about kind of where we are. Yesterday we rallied into the close here in Europe. That's the white line. The US markets then sold off, but again then rallied into the close. That probably leaves us kind of net reasonably neutral in terms of the opening story here in Europe. The real trade this morning, though, from a European perspective, comes from another part of the world. It comes from China. Look at what is happening with the Chinese stock markets right now. They have rallied aggressively. The CSI 300 is up by 4.3% right now on the back of the moves that have been announced a little bit earlier, and we're expecting more. So that's the close. That's the story that we're watching out of China. How does that impact the European story this morning? Kriti, what do futures look like?
Well, the read-through is very, very prominent. You're seeing that outperforms the Euro Stock 50 futures higher by almost 1.2%. The underperformance, though, and this is where we're trying to do a little bit of detective work, is in the FTSE 100. Also seeing green on the screen, so risk sentiment high in the cross-asset picture, but FTSE 100 only higher by 0.6%. Anna, how much of that is a function of what you're seeing on an individual basis?
Yes, we've got Chinese stimulus, we've got traders lifting their ECB easing bets, all of that adding to a risk-on mood. In terms of individual stocks, this is what we have. A complex outlook perhaps for luxury names. We've got UBS cutting their price target on some of those luxury names, but on the same day as we see a lot of stimulus measures in China, will that touch the consumer? Will that be contained within stocks and maybe property? Raspberry Pi in focus, revenues up, no change to guidance though. Commerzbank certainly in focus once again. Yesterday we saw weaker trading for Commerzbank. It looks less likely they'll get a deal done with UniCredit. Well, if UniCredit is going by the signals they're getting from the German government at least, but UniCredit is positioned to own 21% of this bank should it wish to do so. Guy?
Are European equities looking east or are they looking west? That's the question we're about to try and answer as we get to the open. Here we go. It is time for the opening trade. Let's look at the numbers. We're expecting, I think, a more positive picture maybe to emerge. But the FTSE is an interesting question, and I think it's struggling at the moment to get a clear sense of direction. Not really jumping upwards at the moment to the degree that maybe other European markets may. So you've already got the IBEX up by 0.5%. The FTSE's now playing a little bit of catch-up. The 600 is up by 0.4%. I'm waiting to see what the CAC does. How do luxury stocks deliver on the back of what we're seeing out of China? How do German automakers deliver on the back of what we're seeing out of China as well? It's a key core market for them. So we'll wait for for the CAC to open. There you go. It is outperforming by some significant margin this morning, up by 1.34%. The FTSE 100 is a laggard. We'll wait and see how the DAX opens in a moment. Kriti, what is happening below the surface?
Well, let's start with just some of the winners here. And you can kind of tell and make up your mind in terms of that French index outperformance. A lot of it is coming from the luxury space, a clear China read-through, Anna, that we're seeing. But even it's showing up in the mining space as well. If you look at the FTSE 100, your biggest index contributors this morning are Rio Tinto, are Glencore, and then followed by a slew of banking names as well. So it really speaks to this idea of risk-on sentiment. Largely, it seems, coming out of China.
Yeah, risk-on, certainly. Basic resources, that sector as a whole, up by 3.4%. And you see some of the names in the mix that would benefit from higher iron ore prices, higher commodity prices more broadly. We see Antofagasta higher, Rio Tinto higher, Glencore, ArcelorMittal. And we saw iron ore prices through the China session up by 5.8%. So this is quite a substantial move. Oil prices also up by 1.2% on Brent. We're at 74.82. Yes, there's some geopolitical tension in there, but colleagues do seem to be attributing this more to the China move. And so we certainly see that read across. CSI 300, as you pointed out, Guy, closing up by 4.3%, which is not a small move on that market, which is at a 5-year low recently.
The China trade is just written across the market this morning, isn't it? We have decided we are looking east rather than west. This has nothing to do with what's happened yesterday in the States. This is all to do with what the catch-up trade could look like. Luxury names are outperforming. But as we talked to Mark Cudmore a little bit earlier on, Kriti, are we going to see this translating into a better consumer performance out of China? That's the key question for names like Kering and LVMH.
Well, we certainly will, and we should still mention the FTSE is underperforming, so we are going to keep an eye on that one as well. As we talk more about the cross-asset story, I want to quickly mention that we are getting headlines coming out of the EU Commission. They are clearing Swisscom's acquisition, of Vodafone Italia. This is a big deal because one of the concerns, one of the pushback from the Italian government was regarding Telecom Italia, which of course the government has a stake in. It has to do with what rates the Italian consumer faces. So the fact that the EU Commission is giving its a go-ahead is actually good news in terms of that cross-border consolidation, perhaps outside of the banking sector. We're going to keep you apprised of that. Vodafone shares higher by 0.4% in London. Let's go back to the cross-asset story. Michael Snade, head of cross-asset and macro-quantitative strategy over at BNP Paribas Markets 360, joins us around the table. You picked a good day to do so. Good morning. It's almost like it's almost like you planned it. Walk us through this take. I think one of the concerns this morning is it all looks great right now. Is this a knee-jerk reaction that doesn't have the legs to last?
So I think we have to take some context and some expectations into consideration. And I think once we do that, actually the outlook does look quite bullish. And I think it supports the price action that we're seeing this morning. So we saw that heading into this last week, heading into FOMC, investor sentiment actually looked pretty subdued. So some of the core metrics we run to try to pick up investor sentiment said that investors were still trading in a risk-averse manner. That's despite the S&P being at very high levels. And that has given, I think, a bit of a base for risk to rally over the last week and probably rally after this event. Then on China itself, whilst there was building expectations over the last week that something will be delivered, what we've had announced, we think, surpasses those expectations. So again, fuel for fire for this rally.
But we've heard this story before, haven't we, out of China? These rounds of stimulus. No, we haven't heard it all at once and in every possible way. Can they best it, or is this kind of the last attempt from China to really stem some of the losses in the housing market and the stock market? And the reason I ask that is if this is that last attempt and it doesn't last, do you start to see even more pain in Asia?
Yeah, so I think what's really key about this announcement is the signaling effect, in that for the last 6 months it's felt that there's been a need for stimulus to be delivered. Economists have continued to revise down their expectations. The data overall has been soft, but we've not seen that policy response. And that's because policy has been focused more on helping to rebalance the economy, not adding too much debt to the economy. Now that we've had this kind of joint announcement, it shows that there is more of a willingness to accept that the downward trend that we've had in economic activity in China cannot continue, and that policymakers need to step in and deliver more. So I think that signaling is really powerful.
Michael, let me just mention, I mentioned this earlier on in the programme, but just to reiterate, traders lifting their betting around the ECB and the extent of the easing we're going to see from the ECB, seeing a 50% chance of an October cut. So that's the sort of backstory to my question, because I wanted to pivot the conversation to Europe. Europe obviously has a lot at stake when it comes to the Chinese growth story. And you're talking about how actually Europe can just bump around the bottom for quite a long time. It doesn't necessarily have to tip really into a recession. Explain that difference for us, because you think differently about the US and Europe right now.
Yeah, I think there's a really interesting kind of compare and contrast between the US and its slowdown and Europe. The US, we titled our global outlook for this quarter, Cutting It Fine, because we really think that in the US you can be on a bit of a knife edge in that there's potential non-linearities. If you get softening data, a softening labour market, you can cause confidence to weaken, that then causes spending to reduce, and very quickly you can kind of snowball into a much deeper slowdown. We don't think that's going to happen, but it's a risk there on the left-hand tail. In Europe, we deem the situation to be a little bit different because, one, potential growth is much lower, so you can be at zero growth without it really being a substantial slowdown. And then we also see the non-linearities as being more limited. And that's due to some of the more structural rigidities, the fact that the labour market is more rigid in Europe.
Yes.
The savings rate is higher. So this means you don't necessarily get on responsive soft economic news, a knee-jerk reaction from the economy that then causes those non-linearities.
OK, so you don't get the non-linearities, to use your language then, here in Europe. Does that, plus the fact that we're seeing this stimulus package in China, turn you more positive on Europe?
Yeah, so I think, the last 24 hours we've had, real mix in that yesterday the data, it did look very poor. It's not enough
Out of Europe, yes.
Out of Europe, yes. It's not enough to secure that October rate cut, but it certainly really draws attention to the survey data that we get with the IFO today, further surveys later this week, inflation data into this week, early next week. In terms of whether or not this China news can impact that story, we're seeing it, of course, in the European stocks. It's changing the sentiment, but it takes time for the economic impacts of stimulus in China to feed through to support for Europe. So that China stimulus news is probably not enough to take off those downside risks to the European economy just yet.
As we approach the end of the month, bonds and equities are basically neck and neck. What does that tell me about what I want to be doing with my portfolio? Is that the right mix? Do I want to have a balanced portfolio at the moment? Do I want to be risk on or risk off?
So we think in the short term you want to be risk on. We think that investor sentiment can improve. But that doesn't mean that you should necessarily be diluting your bond holdings and increasing your equity holdings, because there are still risks out there. And also, against this backdrop of low inflation, central banks being able to respond to what is a soft landing narrative, this is a good backdrop for bonds. So we think that this is a good time for real money investors to be positioned in both bonds and equities. If we think about the risks that might ensue, we think that there is still risks that you get a deeper slowdown. We're really watching particularly the US labour market.
Yep.
If that was to evolve, then it means your bond allocation is probably going to provide you with protection, which is quite a rarity. And if we look back over the last couple of years, bonds and equities, they've not provided the diversification. And as a result, what we've tended to recommend is that investors need to look at more derivative products or more systematic products to provide that diversification. Actually, investors at the moment can take some comfort that there is that bond equity diversification.
Do I want to focus on diversification or outperformance?
So, if we think about what's coming up, the US election, I think that is going to really focus on diversification, because we think that as we head into the US election, there is going to be an increased period of uncertainty. So we're risk on now, but in October, we're expecting vol is going to rise. You're going to be pricing in more of that election risk premium. It's probably going to create some volatility in equity markets. So diversification, we think, is still going to be quite key for investors.
Great to see you. Thanks for stopping by to see us and join us around the table. Michael Snade, Head of Cross-Asset and Macro Quantitative Strategy at BNP Paribas Markets 360. Thank you very much indeed. Quick look at the core six, just to figure out exactly how some of those luxury names are performing this morning. As you can see, significant outperformance coming through from names like LVMH. Ferrari, interestingly enough, not doing quite so well. Some of the tech names are doing OK, but you are certainly seeing an underperformance of the defensives. Is this the time to turn back to cyclicals? Maybe it feels like today, but maybe a different story going forward. We'll see how long this China story lasts. Let's get some single stock movers. Here's Joey.
So luxury is a big focus this morning, Guy, and we're seeing gains across these screens this morning. We've got Swatch, Moncler, Burberry, LVMH among the biggest gainers. Now, bear in mind, on a normal day, these stocks would probably be lower because we've had UBS cutting price targets and ratings on these stocks, recommending selling Swatch because of the recent China weakness, downgrading Moncler a price target, a street low cut on Burberry as well. So I would expect those stocks to be lower if it wasn't for that Chinese news really boosting all of these cyclical and luxury goods spaces as well. But the other area really moving today is the metal stocks leading the gains across European equities today. The best performer was Norsk Hydro. Looks like Anglo-American coming up above that now. Anto, ArcelorMittal, massive gains in those shares, given the jump in some of the base metal prices that we saw overnight on that news of the Chinese stimulus package. Then we're also looking at some share sales in the UK. We mentioned Dunelm, the chairman, offloading a big stake in that today at a decent discount. And we had another placing in Admiral as well. That one looking unchanged at the moment, holding up. That was an employee trust selling some shares in that one. Then in terms of earnings, some big movers today as well. Now we've got Smiths Group, the industrial firm, the engineer in the UK, supplying into communications and energy, a bit of a weak one there. Raspberry Pi, the debut earnings report from them. That's a computer company that listed recently. Pretty strong earnings, up 60% for the company. But Card Factory absolutely slammed on a profit warning. Now, this is related to the national living wage regulation coming in. They're talking about that in their statement, saying that's going to hit their profit margin. So that stock absolutely slammed in London at the moment. And TUI, now this one is saying that the winter bookings are stronger than they've ever been, according to the company there. So that's a positive one. Trading in both the UK and Germany. TUI getting a bit of a boost today. Then finally, we will look at a couple of rating changes that we haven't done yet. AMS Osram, take a look at this one, up almost 10%. This is a semiconductor firm over in Switzerland, semiconductor sensors, that kind of thing. 70% upside to the price target at UBS, which upgrades the stock to buy today, and we're up almost 10% for that one. And then one stock going the other way is Saab. This is in defence. Bank of America downgrading, saying that the rally in some of the defence stocks may have gone too far, and that one is reacting a bit of rare red on the screens this morning, down 5% for Saab as Bank of America downgrades the stock this morning.
Joe, thanks very much. Joe Easton from our equities team. With some of the impact that we're seeing from this Chinese news flow, we've been covering it since the top of the programme. A suite of policy measures coming not just from the PBOC, but from stocks regulators and other regulators in China, pushing up commodity prices, and investors very evidently moving then from fixed income into equities as a result of this. We saw that during the Chinese session. It seems to be something that's taking place in Europe as well.
Are we also going to see this rotation out of defensives, which are outperformed over the last few weeks, into cyclicals? Some evidence of that this morning as well.
Some slight evidence, but I gotta make a fun fact here. David Inglis, our colleague over out of Asia, points out that even with this rally, we are at levels half of what we were at 4 years ago. He said to get back to these levels at an annual kind of rate that we've seen, you still have 4 years to go. He talks about the sustainability issue.
Yeah, on Chinese stocks, we were at 5-year lows before that. I mean, partly that's what prompts some of the policy.
But is this the moment to buy?
Yeah.
If you've got 4 years to get back, it's a 4-year ride all the way back up to those highs.
But to your point earlier, we've been here before. We've had plenty of policy initiatives before from China, and then we've been left asking, is this really the turning point? And it just because something's cheap hasn't necessarily been. And your other point, I think, is really valid. You know, a lot of these measures directed at stocks, how much is the wealth effect from that, and at property? How much of that is sufficient to make a difference to consumers? Obviously, investors are betting that it will today, certainly on the luxury end of things.
You could argue a better performing stock market, the translation into some of the high-end luxury names probably is a more logical conclusion. We've always seen this kind of crypto does well. You see luxury watch sales doing well. That kind of feels like a fairly solid connection, and maybe that's why names like Hermès are doing so well this morning.
And you mentioned the kind of policy story and the economic fundamentals. We should mention they're prior to all of this kind of conundrum and damage that you saw in the Chinese market as well. Investors are already pivoting away from China to the likes of India, South Korea, etc., and this just kind of added to the pain.
OK. What are we going to do next? Let's talk about hedging your bets. We're going to head back to the Wembley Stadium for more hedge fund talk. Mike Asness, CIO AQR, is going to be joining Danny Berger at Wembley. That conversation next. This is Bloomberg.
Welcome back to the opening trade. We're 18 minutes into today's session. Green on the screen across the equities picture. Outperformance over in France. A lot going on in terms of that China read-through. But now let's get back to the hedge fund world. At Kepler's annual gathering at Wembley Stadium, Bloomberg's Danny Berger there for us with an exclusive interview. Danny.
Hey, Kriti, I'm really pleased to say that I'm here with AQR's Clif Asness. Clif, thank you so much for joining this morning.
Thanks for having me.
We have to start with your paper that caused quite a bit of a stir. Let me just read the title for our audience. The Less Efficient Market Hypothesis. Quite the claim for someone who studied under arguably the godfather, Eugene Fama, of the EMH. So what did you see that led you to believe this market is less efficient?
Sure. Well, efficient markets in general are this idea that prices, in some rational sense, reflect all information. That's the extreme version of the hypothesis. Gene tells the class, like third week of class, markets are assuredly not perfectly efficient. And you get a gasp because it's the University of Chicago. Everywhere else in the world, they just go, yeah, we know that. But in Gene's class, that's a gasp. So it begs the question, once you accept they're not perfect, how imperfect and does that change through time? And I'm very clear about this in the paper. A lot of this is op-ed. It's my life experience in this business. But over my career, at the very beginning of my career, when we started AQR, 18 of our first 19 months were the blow-off top of the dot-com bubble. And we did a lot of things back then. We were losing a lot of money. That was the bad part. It wasn't statistically like beyond shocking, but it's not pleasant to happen in your first year and a half. And it turned out that the prices between cheap and expensive stocks, in general, using a bunch of valuation measures, maybe they vary between 6 times more expensive to 3 times more expensive, the expensive stocks. They had shot up to like 13. And they'd never been close. It was 50 years of this and then this. So then you spend a lot of time saying, is there some way we're wrong? Is there a reason this is rational? And if you conclude no, you stick with it. Then if someone had said to me at that point, is this going to happen again in your career? I hopefully would never say never. No one in our field, your field, my field, should ever say never about anything financial. But I think I would have said, oh, yeah, probably not, almost definitely not. Because it hadn't happened in 50 years. My career is not going to be another 50 years. I wish it were, but it's not going to be. And the question in your career presupposes you're still here, and you're not the only one. And you guys are probably in charge. So how's this going to happen again? And then even before COVID, it was getting there. But COVID took that same differential and blew it out of the water.
But Cliff, why can't I argue it'll play out the same as last time? That spreads will come back down, value will work again, and it's just we're in another one of these periods.
That's exactly what we do argue. So you are totally permitted to argue that. But the bigger question I'm trying to answer is I see this as a sign of the market getting less efficient about pricing. And in principle, we all think things should get more efficient over time. Technology marches on, data is more available, things that were available at a lag are available instantly now. But I think most of those things go to speed, not to accurate pricing. Yeah, things get in prices faster. But I think there's strong evidence, so not just these two things, but these are the two major ones I experienced, that the crazy periods are getting crazier and lasting longer. So the next question I ask in the paper, and this is very speculative, I admit, is why? Why? And there are probably other great ones, but I focus on 3, and I'll say them really fast.
Sure.
The first is the rise of passive. That's everyone's favorite. Passive has broken the market. I think that is probably part of it. No one knows how many people can actually be passive without breaking the market, but we know it's not 100%. That's a weird world where nobody is thinking about whether NVIDIA is worth more than a candy store.
Yeah.
So the idea that there would be less could weaken the tether to reality.
I want to let you get to the other two,
sure,
because I find them really interesting. But just in terms of that, especially when we're talking about NVIDIA, and this being a crazy period.
You know quants know nothing about individual stocks, right?
Of course, you know nothing about a single stock. I'm very aware of that. How crazy is this period?
We're still, and I won't talk about NVIDIA in particular, but when it comes to the spread between cheap and expensive stocks, we were at a new 100th percentile in COVID. I jokingly call it the 120th percentile, which from my math friends listening to you, there is no such thing. It's just the new 100th. But it was about 20% above the prior 100th. We're back down to about the 80th percentile spread versus history. We still have a little bit of a tilt on, but far smaller than when it was 120. So I would say things are still out of whack. but it's not an arbitrage you can drive a truck through
right
now. But so I think passive is part of it,
right.
But it's very hard to know how much. The second one I'll do beyond quick. Post-GFC, 10, 15 years of super low interest rates, I don't think justifies these spreads, and we've written a lot about that. But in a very non-technical sense, may that drive investors mad and to do some crazy things? Yes. That's all I'll say about that. My third and favorite hypothesis, because it's so counterintuitive, is I started out saying technology might make things faster but not more accurate. It might, and in fact I would argue probably does, contribute to the less accurate pricing. And in particular, I'm talking about the milieu of instant information, free trading, certainly social media. The dot-com bubble was the first go-around of kind of proto-social media, where you're a little too young for this one, but message boards were very hot. People were all discussing their favorite e-toys and drcoop.coms, and if markets are efficient to some degree, not perfect, the wisdom of crowds, the famous idea that a crowd can be more wise than the average component of the crowd, is a huge part of it.
How much of your Twitter interactions color this? Because you're not afraid to talk. I just, when you're talking to people who you don't agree with online, does some of that color it saying, maybe this crowd isn't so wise?
I hope not. But may it sneak in? I would have to admit it might sneak in. But if a wise crowd is the goal in a market, have we ever had a vehicle better than social media for turning a wise crowd into a dangerous mob? And I'm not going to get political, except I'm not going to choose a political side. But if our politics are not a great example of this, I mean, there was a point 20 years ago where we had utopian views with that social media would make us all like each other more. I don't think I need to convince any of your viewers that that has not happened. And I think a lot of the same has creeped into markets. It's unfair to choose the most crazy example. But a poster child, not a proof, are the U.S. meme stocks. They are the most extreme example of what I'm talking about.
Right.
Crazy valuations driven by social media. But life is not just them and everyone else. It's a point on a spectrum. So I do think markets have gotten somewhat less efficient.
Right.
I think the final interesting question is, what does that mean for a rational style of investing?
Can I ask, because you also point out in your paper that it's a problem for society.
Yeah.
Why is it a problem for society?
Well, if you're actually going to read the paper, it's going to make this all take longer. You know that, right? It's a problem for society, and I think I'll be a cheerleader for our industry.
Yeah,
I don't think
got to be quick here, Cliff. Only 30 seconds.
I don't know if enough people think about it this way, but rational prices are very important to a free enterprise society.
Yeah.
When prices are wildly irrational, prices are how we allocate resources.
Yeah.
And we do it in a very unproductive way if companies that are not very productive and are speculative and pie in the sky are getting all the money.
Yeah.
So it matters. And let me finish with one thought. What does it mean? Well, if markets are somewhat, I don't say they're terrible, less efficient, deviations from fair value
Cliff,
will be...
We got to end it there. I'm so sorry. We're coming up
deviations
against
from fair value will be bigger, last longer, but you'll make more money from them.
Cliff, you nailed it. Thanks so much. That was Cliff Asness of AQR over here at the Kepler conference. This is the opening trade.
Minutes into the opening trade, European equities on the front foot. It is China that is lifting us up today. Luxury stocks in particular are outperforming. You could see that with the French markets, which is up by 1.1% right now. Let's turn from the luxury sector to what is happening in the banking space. Diplomatic tensions between Germany and Italy bursting into the open. This after UniCredit has upped its stake to become Commerzbank's largest shareholder. The Chancellor of Germany, Olaf Scholz, calling the Italian move, quote, unfriendly. Let's get more on this story. Oliver Crook is standing by in Berlin. This moved very quickly, Ollie, and Orchel's approach certainly has caught a lot of people in Berlin on the hop. Now what?
Yeah, Guy, listen, I just want to run through this because, again, this has only been 10 trading days. This was on nobody's radar back on September the 10th here. This is when Orchel was in the market, privately sort of buying this stake, and then in anticipation of the fact that the German government was going to offload that 4.5% stake, which he went in with a fill or kill order and got the full stake. Then suddenly on the 11th, he's got a 9% percentage of the company. There is total confusion both in Berlin, over at Commerzbank. Everything is sort of thrown up in the air. There's a lot of questions about whether Deutsche Bank is going to get involved in some way, be able to block this merger. Then things go quiet for a couple of days. Then going into the weekend, we get the finance ministry in Germany saying basically we're not really in favor of this, still being very diplomatic about it, being a bit quiet about it. So on Monday, you open up, come straight down, only to discover that Orchel has, in the meantime, moved additionally for another 11% stake, taking it to 21% stake in the bank. This would mean that he would be the greatest shareholder. We should say that it's right now only in derivatives because he's not allowed to realize that, that possession of the stake because he doesn't have the permission yet from the regulators to go over 9.9%. But then this has forced Olaf Scholz to come out at the UNGA. He's there to be dealing with sort of high diplomatic issues, the war in Ukraine, dealing with leaders there, to come out and deal with this Commerzbank situation, saying that unfriendly attacks, hostile takeovers are not a good thing for banks. We do not consider this to be an appropriate course of action. So the Chancellor just sort of being blown off course here, but really throwing everything in disarray here, guys. And I think it's probably safe to say there's something smacks a little bit of sort of barbarian at the gates here that we probably have not heard the last from Andrea Orchel on this.
So Ali, that was the German side of things. Talk to us about perhaps the response from Italy.
Yeah, so listen, there are so many different dimensions to the story. It's worth just going through sort of all of them in sort of sequence. There's the domestic question, right? The fact that the government itself is probing its own stake sale, which is quite an embarrassment. The fact that we haven't actually even heard from the Commerzbank shareholders. Shareholders tend to like it when the value of their stock goes up. That is exactly what this UniCredit bid has been doing. We have not really heard from them. Commerzbank is assembling with some of its regulatory board, and they're going to discuss it over the next couple of days. The unions have been out. They've been lobbying the government. They're going to have a press conference at 1 o'clock. And again, the German government is looking at what actually happened here. For the political story within Germany, where you have a sort of surge of nationalism coming up, you also have the opposition leader, Friedrich Merz of the CDU, who's really using this as a sort of a way of saying that the government is incompetent, has mismanaged the stake, that basically it's a disaster for the banking sector. And then, of course, the last is the international sort of dimension of this, where the Italians very unpleased, saying that when it's time to come to Italy and buy a company, it's no problem. But when it comes to going into Germany, suddenly it's no longer a free market.
Oliver, thank you very much. Bloomberg's Oliver Crook there with the latest on Germany. Apologies for the quality of the audio we were getting there. Let's continue this really important conversation, though. We're joined now by Jackie Ineke, CIO at Spring Investments. Really nice to talk to you, Jackie, and thank you for bringing us your take on this. I wonder if you can, not to talk too much about the individual personalities involved necessarily, but give us a sense of the style at which this approach was made, the way that UniCredit has gone about this. Do you think that's why we're seeing some of the pushback in Germany? Do you think that's helping or detracting from this M&A approach at the moment?
Yeah, I've got to say, good morning, everybody. I've got to say it's kind of detracting. It seems to be a generally straightforward acquisition. I mean, it makes a lot of sense. You've heard a lot of this from the equity guys, I guess, less so from the credit guys. But certainly from a credit perspective, the news flow that's going on is really not affecting where bonds are trading. What you have in the credit markets, you've got about 90 billion of debt issued by UniCredit, 60 billion from Commerzbank. And what's happened over the last couple of weeks in terms of the most deeply subordinated debt market, which is what Spring focuses on, AT1s, you've had Commerzbank rise a couple of points. You've had UniCredit come down about 50 basis points. There's still a bit of clear water between the two. You know, there's some more compression to go. But the bottom line from the credit markets is that we like this. The compression has been upwards towards the top where UniCredit's trading. And so we definitely think it's good news, not so much detracted by the flow.
Right, OK. So, I mean, equity markets have been reacting to the likelihood of whether we get a takeover or not. And yesterday we saw the share price, of course, retreat on that news flow. So are bond markets assuming this happens then, Jackie? Is that what you're seeing at this really subordinated level?
Yeah, I mean, this is what we're seeing in the markets for sure. I think there's a couple of things here. First of all, you know, when Orchel says there's a huge potential here and we're going for it, everybody listens. You know, Commerzbank has been an M&A target, arguably, for a number of years. We've been here before, and it's one reason why, you know, we've had a big position in Commerzbank for so long. It's been unloved and trades cheap. But as soon as UniCredit comes back in and opens that, you know, that perspective to the market, that's not going to go away, no matter what happens with UniCredit now. Orchel has said he's going to be very patient. I understand that he's got stakes elsewhere where he's being patient. But I think if something happened that UniCredit had to pull away, I think there's a number of other banks who would be in the door, knocking, looking at it from a perspective of maybe less impact on the labour unions for Commerzbank. That would be, I presume, a lot more palatable in Germany.
Jackie, good morning. It's Guy. Does UniCredit trade as a German credit if it were to take over Commerzbank rather than Italian credit, or is that a distinction we don't need to make?
I think you don't need to make that. I mean, of course, they already own HVB, and they're very well diversified geographically already, yet it still has a little bit of a... you know, obviously it trades from its Italian nature. I mean, one thing I would say is that we don't really want to trade it as a German credit, because actually UniCredit right now has a lower rating than Commerzbank, and yet UniCredit trades better than Commerzbank. So actually we don't really want that German angle to it. So I think if this acquisition goes through, and then they'd make, you know, the size would be 1.3 trillion in total assets. My gut feel is that, you know, as the credit markets are showing you now, they trade up to where UniCredit was trading before. You know, they don't meet in the middle. So I think it's good that it trades like a strong, diversified Italian bank.
In terms of what the other options are, there's some talk that maybe you could merge Commerzbank and HVB. There's all kinds of permutations that are being talked around that. Is a full takeover the only option that we should think about here?
Gosh, that's an interesting one. My guess is I think that's what Orchel wants to do. That's a hard one to answer. Honestly, what the credit markets are saying is that this is going to go through as a full acquisition if it happens. I think other permutations is not what Orchel's after. And again, he says he's going to be patient. He can wait on the sidelines for a very long time.
Jackie, it's Kriti in London. I want to pick up on that point you made about UniCredit not trading necessarily as a German debt instrument, because it's not the only company, or bank in Europe that's looking for that German exposure. BBVA has been making significant investments in Germany as well, arguably to its own detriment, considering Germany is largely considered as overbanked. It's also engaged in its own acquisition of its own with Banco Sabadell. Walk us through your take on that company and that credit.
Yeah, that's a great question. Obviously, this kind of underlines the strength of European banks right now. You know, if you take a step back, and I don't think there's been a lot of focus on this, but European banks have been through the ringer with regulations for the last 15 years. They're overcapitalized, and that's me as a credit analyst. I love banks being hugely capitalized, but arguably they've got too much capital now. To put that into context, probably the average equity ratio was like 6% before the financial crisis. Now UniCredit's at 16%. It's far too much. The minimum requirement is closer to 10. So banks have a lot of firepower, and I think you'll see a lot more M&A coming, because I think we've reached peak capital. What do you do with it? Do you deploy it? Do you do what UniCredit's doing, what BBVA is doing, as you point out? Or do you buy back shares? You know, banks are still buying back shares. We had 25 billion in the first half, but banks are still overcapitalized. From BBVA's perspective, you know, again, they're chasing Sabadell right now, and they're looking for more diversification outside of Spain, as well as becoming a larger bank in Spain, where I think they're struggling a little bit. But again, from a credit market perspective, what you've seen is that the credit markets love this BBVA potential Sabadell acquisition. Again, from a credit spread perspective, you've seen those two compress. Sabadell moving up to meet, the higher and better trade in BBVA.
Jackie, you made an interesting comment, which is the strength of European banks, and I couldn't agree with you more that the buybacks that you're seeing out of the banking industry, especially in Europe, are pretty eye-watering. Is it strength in European banking as a whole, or is it strength that we're seeing, or outperformance that we're seeing in peripheral Europe banks? Do you see that distinction?
Honestly, Kriti, I would say the peripheral banks are generally better capitalised. Again, depending on how far you want to go, the Greek banks are some of the best capitalised banks now, much better than the French banks, for example. But of course, there was a lot more failures, or huge failures, through the crisis and the sovereign crisis thereafter. So they've been forced to massively recapitalise, reduce non-performing loans, get themselves in the best shape they can. I mean, again, at Spring, this is a big focus for us. The Greek banking sector is superb and the economics are great. So I think it's nuanced, though. I think all the European banks have been through this 15 years of heavy, heavy regulations. Look at the share price action over most of that time. It's been horrendous, because if your capital's going up and up and up 2 to 3 times, of course your ROE is going to struggle. But for creditors, it's been fantastic. But I really think we are at peak capital now, and it's generally.
Jackie, do you think Orchel stops here? Is there a logic to continuing? Are there other banks that you think would fit into what he is building? And do you think this is a process that will happen relatively quickly? He seems to be a man in a hurry. I appreciate you saying that he's got time on his side at the moment, but he does seem to be moving relatively quickly. How far do you think his ambitions may go?
Well, you know what? He's got an absolute war chest in terms of capital. He's got far, far too much capital in that bank. And again, what's he going to do? Buy it all back? The ECB won't let him buy it back all at once. It's going to be a year's process of doing that. So if he sees targets that make a lot of sense, and he's been very clear, very consistent about what he's looking for, then, he will add. I mean, this is a huge acquisition, so I'm sure this will take the whole time. Right now, I think it'd be crazy to say he's going to move to somebody else. But he also has, nearly a 10% stake in Alpha Bank in Greece. That was through the Romanian kind of acquisitions they did. So, it has a number of fingers in a number of pies, and the firepower. I mean, this is how he can make this bold move. So, if this gets rebuffed, if it was to end tomorrow, which I absolutely don't think, there are plenty of other options, I think, for him to chase.
Jackie, you were clearly quite positive about the sector, but looking at the individual names that you like, they're all quite small. I wonder what draws you, what makes you think that it's now the right time for some of the smaller players? That's not about M&A, I don't think. What is it that draws you to them?
Actually, it's a mix. We can, we have this AT1 fund, we can go in, we can buy BNP, we can buy UBS, we can buy Lloyds. That's great. But I think really where you get the outperformance is in some of the smaller names. They're small, they have small bond issues, but they're some of the strongest banks in Europe. So, we like to focus on those. I mean, there's, Van Lanschot in Holland, it's a wealth manager, it's super, and it trades cheap. A few others that we like are actually, I would say, acquisition targets in years to come and are currently being turned around, like CCF, like the Volksbank, like OLB in Germany. These are all names we really like. And I think that's where, they're under-researched, they're small. Some of the very, very big funds can't look at these small names. That's where the opportunity is. Don't get me wrong, we do have the UBSs, the BNPs, but I think the outperformance is doing the analysis on the smaller names. And, as I mentioned, so many banks have so much capital, they'll be looking for acquisitions. They are. And the domestic acquisitions are clearly much, much easier than what UniCredit's doing.
Jackie, thank you. Thank you very much for joining us. Really good to get your perspective. Jackie Inniker, CIO at Spring Investments. 8:45 here in London. Coming up on the programme, Africa's richest person, Aliko Dangote, says it is time for Nigeria to end fuel subsidies. We will bring you part of our exclusive conversation with the CEO and founder of Dangote Group next. This is Bloomberg.
subsidy is a very sensitive issue. If, I believe the problem is not only the subsidy, it is problem that, once you are subsidizing something, then people will be blotting the numbers and government will end up paying what they are not supposed to be paying. But this, our refinery, will bring quite a lot of issues out there. It will show the real consumption of Nigeria. Because, nobody can tell you. Some people say 60 million liters of gasoline per day. Some say, no, it's less. But right now, if you look at it, by us producing, okay, everything can be counted. Right. So everything can be accounted for. And most of the trucks or ships that will come and load from us, we are going to actually, put a tracker on them to be sure they are going to take the oil within Nigeria. And that, I think, can help the government to save quite a lot of money.
So do you think it's the right time to get rid of the subsidies?
I think it is, because all countries have actually gotten rid of subsidies. Let me give you an example. Saudi Arabia used to give what Saudis, the citizens, believe that, look, oil is our own God-given gift. So the government shouldn't charge us for it. So government were selling it at a very low price. But today, as we speak, gasoline is about 40% cheaper in Nigeria than in Saudi Arabia, which I think it doesn't make sense. That is one. Number two, our price of gasoline is about 60% of the price of our neighboring countries. And we have very porous borders. So it is not sustainable. The amount of subsidies that we're paying, government cannot afford those subsidies.
So do you need the government to take away the subsidies for your refinery to be viable?
Well, you see, we have a choice of either when we produce, we export, and when we produce, we sell locally. But we're a private company. And yes, it's true, we have to make a profit. We build something worth $20 billion, so definitely we have to make money. The removal of subsidy is totally dependent on the government, not on us. We cannot change, price. But I think, the government will have to, give up something for something, So I think at the end of the day, the subsidy will have to go.
Dangote Group founder and chairman and CEO Aliko Dangote speaking to our very own Francine Lacqua. Let's go to another story we're watching from around the world. Israel has launched airstrikes across southern Lebanon, killing nearly 500 people, marking one of the deadliest days of fighting in nearly 2 decades. Meanwhile, the United States says it's sending a small number of additional troops to the region, urging restraint as fears of an all-out war grow. Bloomberg Horizon's anchor Jumana Bersechi joins us around the table. Jumana, a tragic situation in Lebanon. Of course, the concerns here are now around the prospects of a ground invasion on Lebanon. How seriously should we be taking that threat?
Well, let me just recap some of the events that happened in the last 24 hours, because it was the deadliest day for Lebanon since the 2006 Lebanon-Israel war that went on for over a month. There were a series of airstrikes, not just in southern Lebanon, but in Beirut suburbs and in East Bekaa, which is very close to the Syrian border as well. Israeli military say that they launched airstrikes on 1,300 military targets. But by the end of the day, the Lebanese Health Ministry put the total figure of nearly 500 deaths, including 58 women, 35 children, 1,650 people being wounded throughout the course of the day. So very, very high toll here. What we saw over the course of the evening and late in the afternoon is, in retaliation, Hezbollah also fired rockets into northern Israel, into Haifa. Sirens went off. Most of those rockets were intercepted. And this morning, more sirens have gone off as well. But there is no indication from either side that we are heading towards a de-escalation. If anything, the rhetoric from Israel and even from Lebanon, from Hezbollah themselves, and the fact that they have retaliated this morning and throughout the course of yesterday afternoon tells you that they don't want to be backing down, or don't want to be seen as backing down, even though, as we've been reporting, many of their senior military commanders and their senior fighters have been killed in the last week.
Why is the casualty count so high if these are military targets?
So Israeli military have said that they have been aiming for military targets. They have also said that the Hezbollah group have placed rocket launchers in people's private homes. The IDF also sent messages to many Lebanese residents over the course of the morning yesterday, warning people to leave their homes and to take those messages seriously because an airstrike was coming. Now, the issue in Lebanon is there is no such thing as bomb shelters. There are not lots of places where people can go. A lot of panic and fear ensued. It was very difficult for people to move out of their homes. There are traffic jams for 3-4 hours from South Lebanon all the way up to Beirut. And the health ministry, the state-owned Lebanese TV network in the evening was saying that buried under the rubble were entire families. So the Lebanese ministry are saying that this isn't just military targets or military commandos have been hit, but entire families, women and children as well. From Israel's perspective, they say that they have given residents warning and therefore they would have had ample time to move away.
Jemana, thank you very much. Bloomberg Horizons anchor Jemana Bassett in London this week and able to give us an update on what is happening on the ground in Lebanon. Let us turn our attention back to what is driving markets this morning, and clearly the Chinese news flow has been front and centre for what we're seeing. Asian equities had a very strong session. The Hong Kong market up by nearly 4%. The CSI 300 was up really strongly during the Asian session, and we do see that filtering through into the markets here in Europe. Basic resources, that sector up by more than 4.3% as iron ore prices and the like push higher as we see coordinated efforts to stimulate the economy over in China.
Yeah, this is an interesting one because, of course, this is a sector that has actually been the underperformer lately when we talked about even that brief rise that we saw in copper prices and then coming back down. It shows up in the luxury sector as well.
So you go to your GRI, you look at the sector story, you look at it over the last 3 months. Best three performing sectors, real estate, telecoms and retail. The defensive end of the market has done best. You look at what is the worst performing sector today, telecoms, utilities and real estate. The market's rotating out of the defensive names that it's been in over the last few months. As we start to maybe see this move back into luxury, is that going to be sustained?
Yeah.
Are we going to see a consumer pickup in China is the question on the back of that.
Absolutely. Does the stimulus that we're seeing, does it stay in stocks? It spreads into property, it seems. Is that enough to drive the consumer over in China? Thinking about where we go on the global economic story, a lot at stake for Germany, of course, from what goes on in China. And that takes us on to a conversation coming up in the next hour. We'll be, of course, tuning in just 4 minutes, in fact, for the IFO numbers, the climate, the assessment of the current state and the expectations all seen dropping versus the prior period on the IFO reading on Germany.
October, is it live for the ECB? That is the key question. We'll maybe ask that question to the president of the IFO Institute. Clement Fust is going to be joining Bloomberg next. That's it for the opening trade. The Pulse is up next. This is Bloomberg.